Hey, what's up, YouTube? You know, it's your boy JB. You rocking with me and I'm rocking with you, and I want to welcome you guys back to the channel Stocks on the Go. Guys, if you are new to the channel, please go ahead, hit the subscription button, tap on the notification bell, and pound on the like button, guys. It really does help with the algorithm of this video. Also, guys, please do remember to take full advantage of the links in the description, guys, for some easy ways to make some quick cash. It also helps out with the what's up, YouTube? You know, it's your boy Mr. Stocks on the Go, and I'm back with a brand new video, guys. Let me see you go ahead and smash that like button, tap on the notification bell, and smash that subscription button, guys. If you are new to investing, guys, go ahead, check out the link in the description to sign up with Wealthsimple Trade. I've been telling you guys for 3 years now, this is hands down the best user-friendly platform out there to get invested right now, to start investing today, guys. And if you sign up with my referral link, you get a bonus, a cash bonus between $5,000 to $3,000 just from depositing $1, as little as $1, guys. You can't beat that. All right, guys. So, guys, let's get back into what we came to talk about, and that is my favorite REIT. Guys, REITs in this market right now, in this current time, they are getting smashed. High interest rates, guys. It's literally breaking the back of REITs. All right, and a lot of these REITs, they're down to their 52-week low. And it's just crazy out here. A lot of opportunity, though, guys. A lot of opportunity. And that's why I came to talk about this REIT today, which I think has so much potential, so much great potential, guys. It also does pay a nice dividend. And I stumbled on an interview with the CEO, which is a recent interview, and I thought that, hey, I have to bring this to the family. All right, guys, so go ahead, smash the like button again, guys, and we're going to get straight into this video. So before that, I'm going to tell you what REIT we're here to talk about, and it's none other than Grt-Un-To Real Estate Investment Trust. Guys, this stock is a beast of a REIT. It's currently sitting at $71.47 Canadian. Guys, it has a market cap of 4.56 billion. All right. This REIT, guys, it's one of my favorites, and I can't stop investing in it. I can't stop buying the lows, DCA, and into this company because I see so much potential. And I'm by no means your financial advisor, so before investing in any company, guys, please do your own due diligence. So before we get into the video that I stumbled on, that I think is so important for us as investors to know into this company, I'm just going to give you guys a description for those who don't know this REIT. All right, Grt-Un-To is a Canadian-based REIT engaged in the acquisition, development, ownership, and management of logistic warehouses and industrial properties in North America and Europe. Grt-Un-To owns 140 investment properties representing approximately 59.4 million square feet of leasable area. Guys, that's just amazing. And as you can see, they're mainly into the industrial warehousing business, guys. And a country needs to keep people working. You know, warehouses are going to continuously get rented out. All right, guys. So let's jump straight into that video that I stumbled on with the CEO, and he's going to answer a lot of our questions. If you're buying this REIT just for the dividends, there's something in this that you really want to wait for till the end of the video that I'm going to show you guys something in the interview. So guys, stick around. This is going to be a real interesting video. All right, guys, so let's jump straight into this video, and it's basically the CEO of Middlefield asking the CEO of Grt-Un-To Real Estate Investment Trust, what is the outlook for the company? What's the plans for expansion? What's the plans for growth? And I think that this is something that us as investors want to know. Are we buying this company strictly for the dividends, or are we buying it for the growth and the dividends, guys? And I think that is important. So go ahead again, smash the like button, and let's jump straight into this video.
You look forward here, Kevin, especially given, say, the relative strength of, say, the GTA market. I've heard Blackstone and I've heard other players like Prologis just talk effusively about this GTA market, which is, Lake of the South, largest green belt in the developed world, basically covering the north, the east, and the west. Rents really moving very aggressively. Is there any thought about maybe increasing your presence here, or in Europe, where you might see some opportunities through distress over time that might alter this current geographic mix?
Well, I think, number one, the GTA is our single largest market. I think it remains our most important market, and it's something we've always been interested in. I think we've tried to maintain a pricing discipline, and that continues today. And this is all about pricing. And to me, I mean, Blackstone's been very active, but they've at times been the only one that's been very active, and we worry about that. And to put it into context, though, every quarter, and it makes sense, I've been spending more time on leasing fundamentals and talking about it on the calls. And I want questions from analysts. I want to have this discussion. When you look at the second quarter, in the first quarter, as a matter of fact, in the first quarter of this year, the only market where we saw net absorption in any of our markets was here in the GTA. And in the second quarter, 2 million feet of net absorption in Toronto, healthy but below the 10-year average. In terms of our markets, including in the US, it was 10th in terms of net absorption, which is growth in occupied space. And in the US, the top 8 markets for net absorption in the second quarter were our markets. So we're looking at opportunities everywhere. Obviously, we would love to grow in the GTA. And I mean that, and we always are looking at opportunities, but we just don't see pricing making sense right now. In terms of Europe, what's interesting to us is we have seen pricing move up for assets that have longer term leases with contractual CPI in this case, but long-term leases that are locked in. That's something that we haven't seen for a while, and now that's starting to come back. So maybe there is this sort of opening for stability. Investors are looking for core product and stability, and sustainability matters. I think when we're looking at large investments now, investors are starting to pay attention to the sustainability features of the portfolios, and understanding that you're buying small bay, it's older product, you feel you can push rents higher in a shorter amount of time, but you also have risks. And some of that is just the sustainability and obsolescence, which is a real risk now, and I think people are paying more attention to it. So I think it's an encouraging sign for us in Europe, and we are interested in growing there because we're finally starting to see that sort of embedded rent growth that we've been expecting for many years.
All right, guys, so we are back, and I hope that answered a lot of your questions with what's the outlook of the company, expansion. All right, so the next question that people might want to ask is, yes, we know that this company is looking to grow, which is good, but what about the dividends? Are the dividends going to grow over time? Can we expect that? And I have the answers for you guys. So let's jump straight into this video with the answer for you guys and myself also. Can we expect a growth in the dividend? All right, let's jump straight in.
One thing we've come to rely on is that annual growth in dividend. Kevin, do you think that's going to be something that we can continue to expect going forward?
Well, that's a board decision, but I would say I think you've seen how important to us to put ourselves in the right position every year to do that. And at a Q2 payout ratio of 73% AFFO, I think we've done that again. So I remember when I joined 5 years ago and was looking at the distribution and whether to increase it, and I thought, you always try and make the right capital allocation for long-term value for investors. But at the end of the day, I didn't want to be that CEO that came in and stopped that track record. And I don't want to be that CEO that stops that track record. So it's really important to me and to us as an organization to put ourselves in a position to be able to do that. And I think we've done it again this year.
That's excellent. It's good to hear. With respect to stock price, something we can't control. The market's going to do what the market's going to do. You're driving the fundamentals in the business. I think there's been a number of reasons why, some more important than others, why REIT prices generally, not just Granite, have been held back and moving rates. What do you think some of the catalysts might be for the market to realize that there is real value here, trading at a substantial discount to what we think it's worth? What do you think some of those
are? And it's hard to see that it's tied to NAV because it's become fully detached from NAV. And I look at, you mentioned, I look at our price down over 30% from its highs in 2021, and yet our cash flow is up 20%. That's quite a swing. But understanding that everything that was low yield got hurt more than others because of the move in interest rates. But we really are confident and optimistic for 2024 because we feel that once the central banks stop, just signal that they're going to stop and take a pause, and there is that possibility of rate cuts. I think a lot of investors, REIT investors, and even private investors are just waiting for a signal that central banks are going to stop. And I think that will be a real catalyst for us. I think the fundamentals are there. We've done what we have to do.
That's clear.
But I mentioned when people do talk about what differentiates us, I do point out selfishly that we spent $750 million on development ostensibly in 2022 with no income. But we had the cash, we had the balance sheet to do it. It made sense. But now that's starting to come online. Same property NOI is accelerated. We'll be around 7% this year, 6.5% to 7%. We expect similar, maybe even better next year. So the cash flow is going to continue to grow attractively. So we've done our job, and I think once the central bank signal some sort of pause, I think will be a real catalyst for the entire REIT sector and not just.
Yeah.